Alright, hey class, welcome to the Chapter 9 video. So Chapter 9 covers the topic of economic growth. So you hear all the time people talking about the economy, is it growing, is it declining? This chapter really gets into what that really means and some of the reasons for economic growth. And a little bit about what governments can do to stimulate that growth. So the first point, I guess, that's important is to understand that you will often hear statistics on the news, on the radio, saying things like, well, the economy grew 2.5% last quarter. From an economist's perspective, things that happen quarter to quarter aren't really truly economic growth. Okay, so the economy goes up and down with the business cycle. There are normal ups and downs, but those don't really represent true economic growth. Economic growth means that there are changes in our potential output, meaning what the economy is capable of producing if all of our factors of production are fully utilized. So if you look at either of these graphs, you see one curve that kind of goes up and down. That's the action of the economy, quarter to quarter, cycle to cycle. But the smoother line, the red one in the graph on the left or the green one in the graph on the right, that represents our potential output. So potential output, again, is what we can produce if all of our factors of production are fully employed. It may seem confusing, but we can go above that. We can go beyond our potential output for short periods of time just by overworking our resources or pulling people into the labor force who maybe weren't working otherwise, but it's not really sustainable. So that potential output is kind of a long-run aggregate supply, long-run sustainable level of output. So economic growth really means changes in that, the potential output. Here are two more looks at that. So the one on the left shows you a production possibilities curve again. So economic growth in that sense represents shifting outward of the production possibilities curve, which allows us to make more of all types of goods. In this case, it says capital goods and consumer goods. So if the economy is growing, we can make more of all those things. The graph on the right shows you aggregate demand and long-run aggregate supply. So in that graph, economic growth means that long-run aggregate supply, which is our potential output again, is shifting out to the right. So we actually have the resources to produce more stuff. So that's what economic growth really is. You see a lot of numbers and statistics in this chapter. There's an important difference to understand between just output, such as GDP, and output per capita. So both are important, they're both meaningful, but they both have different meanings that are important for different reasons. So output is just a measure of how big an economy is, how much stuff an economy produces. Output per capita takes that and divides it by a country or state's population and gives you some measure of kind of how the average person's standard of living is. So good examples here. The U.S. has a nominal GDP last year of a little over 19 trillion. China's was about 12 trillion, so not quite as big as ours, but it's sort of close. Luxembourg has one of a little over 62 billion, so much, much, much smaller output from Luxembourg. Their economy is much smaller than ours. U.S. population is like 326 million. China's is 1.4 billion. Luxembourg's is barely over 500,000. So again, Luxembourg's population is much smaller than ours. But if you take those and divide the GDP by the population, you'll get a measure of output per capita. So for the U.S., that's a little over $59,000. So that's kind of about an estimate of what you could say the average American has to live on. In China, that output per capita is only a little over $8,500. So despite all this talk about China and how they're growing and they're such a big economy, the average Chinese person is still very, very poor. But look at Luxembourg. Output per capita there is over $106,000. So even though their economy looks really tiny compared to ours, Luxembourg is actually a very, very wealthy country, one of the richest in the world. So just understand, I guess, the interpretation of those and when and why you would look at GDP versus GDP per capita. The rule of 72 is pretty handy. not only for this chapter and for thinking about the economy, but even in your personal finance life. Anything that can be expressed as a growth rate as a percent. So whether that's the growth of an economy or the growth of some money you have invested somewhere or the value of your home or something like that. Anything that's growing at a certain percentage rate, you take that rate of growth and divide it into 72. The number that you get gives you an estimate of the doubling time. So that's the amount of years or the amount of time that it would take that growing thing to double in size. So just for an example, an economy, say the U.S. economy, if it were growing at 3.6%, that's pretty fast, that's pretty good. But if the economy grew at 3%, 3.6% annually, 72 divided by 3.6 is 20. That tells you that if our economy kept growing at that level, the economy would double in about 20 years. So this chapter uses that kind of to talk about economic growth, but you can also use that in your own life. If you have something like your 401k, or you have some money that's invested in stocks, it's really useful, just kind of a quick, easy way of thinking about your future. If you've got $100,000 in your 401k and it's been averaging 7% growth return, it's going to double about every 10 years. That kind of gives you a way of thinking about that. So that's pretty handy. Okay, this chapter also introduces you to the aggregate production function. So really what this is the production function for labor. They don't really specify that, but it has employment on the horizontal axis on the bottom and real GDP, so real inflation-adjusted output on the y-axis. Importantly, this production function assumes that capital, natural resources, and technology are unchanged. So all of our other resources are unchanged. So what this graph is showing you is if we just add more and more workers to the economy to a fixed amount of capital, natural resources, and technology, what happens to GDP? And as you might expect, it is a positive slope. More workers produce more stuff, but it increases at a decreasing rate because at some point, if you can imagine on a smaller scale, in one factory, if you had a fixed factory size, fixed amount of machinery, putting more and more workers in that factory at some point gets less and less productive. So the same thing is true with the economy. You can't just add more and more workers. You need to add more of those other things as well: capital, natural resources, and technology. So this phenomenon is known as the diminishing marginal returns to labor, which means that as you add more and more labor, the marginal return, the additional return from each worker, begins to diminish at some point. Okay, this graph shows connections between three different things. So you have the labor market on the left, that aggregate production function in the middle, and long-run aggregate supply on the right. This is right out of chapter 9, but the example given is an improvement in technology. So if an improvement in technology, you look at panel B first, shifts the production function up, that makes labor more productive. That will increase the demand for labor. So that's what you see in panel A, increasing demand for labor. That pushes the wage rate up and causes more people to be employed. More people employed doing more productive things pushes the long run aggregate supply curve out to the right. So this is showing you economic growth. All right, I think that's it. That is the end of chapter 9, so hope that helps. Thanks. I'll see you in chapter 10.